Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Today, we are very excited to welcome you back to another episode of this Bursa webinar. Today, we are going to study in detail risk management for stock portfolio. Now, as you know, the stock market is the stocks are risky asset. So it is very important that we do prudent risk management so that we can protect our hard-earned money. So today, our aim is to share about the stock risk management tips for your portfolio. All right. So welcome everybody. So if you are ready for these sessions, let us know whether you are ready or not. Okay, type ready if you are ready. Okay. We are very excited to have you here again. All right. Cool. So the audio webcam and slide are perfect. Okay, now disclaimer, whatever we want to share on this webinar is only for educational purpose. In no way that I give any recommendation to buy or sell any companies in this webinar. So if you decide to do any investment decision after this webinar, you do it at your own risk. Now today we have invited fund manager, okay, Jerry Lee, to come and share with us about his knowledge in risk management. Now, Jerry Lee is currently a fund manager in one of Asia's largest listed wealth management institutions. Now, his asset management portfolio is over 9 digits, okay, which is at least hundreds of millions. So he has more than 10 years of trading experience and has been trading on Malaysia and US stock as well as commodities and indices futures for a number of years. So he practices technical analysis for majority of his investment in the past 10 years. And he has more than 3 years of experience in teaching technical analysis. So on top of that, Jerry is a CFA chartered holder. So in short, Jerry knows both sides of the analysis, whether fundamental or technical, and he oversees his asset allocation in not only Malaysia but all over the world. So today we are very honored to have got Jerry Lee to come to our webinar as our guest speaker to share with us his risk management strategy to building a resilient portfolio. All right. So with that, I would like to hand over the session to you, Jerry.
Okay, thank you, Shane. Good evening, everyone. So before I start my presentations, allow me to share my screen first. Okay, yeah, Shane, will you be able to see my screen?
Perfect.
Okay, thank you so much. Let me test my pen first also. Okay. Okay, cool. All right. Okay, good evening, everyone. Before I start, first of all, would like to extend my thanks to Bursa Malaysia and also LifeChamp for organizing this event, and thanks for inviting me to conduct today's sessions. So over the next 45 minutes to 1 hour, I'm going to discuss with all of you on the risk management for stock portfolio or for stock investing, because think about it personally, I always feel that risk management is the most important thing that everyone should actually learn before you starting your own investment. And try to ask yourself, I'm not sure whether you have experienced this, but to be very honest, I actually experienced this during the early days of my investment journey. So try to imagine if during your investment journey, have you ever experienced that during time when you make profit for your investment, the profit is rather small and as compared to time when you make a loss? For example, when it comes to profit, you make about probably 3,000, 5,000. But when it comes to loss, you can lose about 10, 15, 20,000 every trade. So if you ever experienced this, right, I think the reason of you experiencing this is because you don't have a prudent risk management strategy. You don't know how to manage your risk. That's why when market is volatile, when market drop, you don't have a strategy that help you to cater to reduce the drawdown of your portfolio. And this is exactly what we are going to discuss for the whole session of today. So if we go move on, like what Shane have just shared, disclaimer. For today's sessions, everything that I'm going to share over the next few slides is mainly for education purpose. There's no any buy sell call. If you want to buy any stock or sell any stock, please do your own analysis carefully. Yeah, okay. I understand. I guess every one of you will probably see these quotes before from one of the very famous value investor in the world, Warren Buffett. His advice to everyone is that there's two rules for investment. First rule, never lose money. And second rule is that never forget rule number one. So I think regarding this code, right? I think majority of the people, they probably misunderstood the meaning. Because when I tell this to all my friends, they always tell me, "Hey, how to make it, how not to lose money in investment, because everything involves risk." I invest into the stock. Definitely there's a chance of me losing money. So how to not losing money? How's to follow the advice from Warren Buffett? If you think about it, if you did we understand the meaning of these two codes, it's not about asking you not to lose money in investment, but it's all about risk management strategy and also how to minimize losses. Because if you try to think about it, there's no single investment product in the universe that can guarantee you not losing any money. Then even if you look at FD itself, fixed deposit. For PIDM, they actually guarantee you up to 250,000. Anything beyond that, no, there's no guarantee. So if you think about it in terms of investment, when you come to investment, when you come to putting your money for investment, always there will be a risk. And the most important thing is about how to manage the risk. Okay, so if you think about risk management strategy, in fact, it's not about preventing yourself from making losses, but if you think about it, it's actually avoid huge and unnecessary losses in your investment. And try to imagine a little bit, right? Having a prudent risk management strategy is actually similar to having a seatbelt in your car. The purpose of the seatbelt is actually not to prevent accident. Having a seatbelt in the car, it can't prevent accident from happening, but it will help you to reduce the impact of the accident. And that's exactly what we are going to explore for today's sessions. So if you look at over the next few slides, first, before we understand about what are the strategy to manage the risk for our portfolio, I think we have to acknowledge a few facts. These are the three facts that everyone have to acknowledge before you were able to construct or you will be able to develop a prudent risk management strategy for yourself. So number one, the first fact is that you need to acknowledge that we can't control or even predict the direction of the stock prices over a short period of time. For example, after buying into the stock, you won't be able to control whether or not the stock price will go up or go down. It's actually driven by the market forces. And you over a short period of time, right, you won't be able to predict whether or not the price will go up or down. If you're investing based on fundamentals, based on value investing, for sure, or not to say for sure, there's a high chance that this stock in a longer term, 3 years to 5 years, probably it can go higher. The stock prices can go higher because based on fundamental, the company has been making good profit every year, 20% kind of a earnings growth. And with this kind of a profit growth, definitely the share prices will go up. It's a matter of time. But think about it in the short term horizon, over the next few weeks, over the next 1 to 2 months, there's still a chance, there's still a probability that the stock prices will go down. So that's why the first fact that you need to acknowledge is that we can't control or predict direction of the stock prices over a short period of time. And the second thing, I'm not sure is everyone of you agree with this, but personally, I'm very agree to this statement because it means that investment is a game of probability. Because some of you probably, if probably you do value investing and you analyze the company in very details, you will have that kind of confidence and conviction to say that no, it's not a game of probability. I understand the company inside out. I know exactly what the management is doing. I know exactly what the business is. So I know for sure the price will go up. But try to think about it, in the investment world, there's a lot of things that you don't know. And you need to acknowledge the fact that there's a lot of things that you don't know. If you don't mind, I share you one of my investment experience that I actually, I think few years, I think 6, 7 years back, actually invested in a stock that listed in a Singapore exchange. And what happened back then is that this company is a fantastic company, earning growth double digit for the past 5 to 10 years. And they have very good and very healthy balance sheet. But towards the end, what happened to this company is that they actually went bankrupt. And the reason why is because the founder itself, the founder itself, he actually pledged all his shareholding to the bank, and he actually did some sort of illegal activity or whatever, and that why it caused the bank to force sell all his stock, and that's the reason why towards the end the company actually went bankrupt. So no matter how good the company is, there is still a risk on the management team, and we need to acknowledge the fact that we wouldn't be able to understand inside out about the management. We will be able to look through some of the financial statement, some of the annual report to assess the credibility, to assess the integrity of the management of the company, but we won't be able to know inside out. That's why no matter how detailed analysis that you have done, you need to acknowledge the fact that investment is really a game of probability. There is still a chance that you will lose your money. So bear in mind of this, there's no 100% for sure win kind of thing. So people always say, oh, I know about this company, 100% sure win one, just all in. Recently I actually aware that a lot of people like to use this word, all in, just all in that stock, just all in this stock. But bear in mind, investment is really a game of probability. Don't simply all in any stock. You need to have a prudent risk management strategy for your own investment. And the third thing, this is something very important. I hope every one of you really understand this. Because when I talk to a lot of my friends, they always believe that when it comes to investment, I only need to know how much I'm going to make from this trade, how much profit am I going to make, how much money am I going to make from this stock. But think about it over a long period of time. To be a sustainable long-term winner, it is not about how much you make from each of the trades. It is about how much you lose from each of your trades. The best loser will be the long-term winner in the stock markets. Remember this thing. I believe many of you will think that, when it comes to stock investment, I just need to find a winning strategy for myself. I have to go into the technical analysis indicators, the strategy, which are the best strategy to use, which combination of indicators will make me win more money. But really, try to believe me, over a long period of time, if you want to be a sustainable long-term winner in the stock market, it is not how much you win from each of your trade, but it's about how you actually control your losses from each of the trades. Okay, so these are the three key facts, or these are the three key concepts that we have to acknowledge. First thing, we can't control, we can't predict the direction of the stock prices. Second thing, investment is a game of probability, so there's no 100% sure win kind of a trades. And the third thing, we want to be the best loser in the stock markets, because the best loser will ultimately be the long-term winner in the stock market. So these are the three key facts that every one of you have to bear in mind. And we move on to the next slide. Here you can see risk management strategy. For me, I actually split it out into two parts. The first part is actually on the fundamental perspective. And then we have the second part is actually on the technical perspective. So on a fundamental perspective, there are three things that you need to do for your portfolio. The first one is that you need to know how to pick a stock. You need to know the strategy, how to understand a company, and what are the questions that you need to ask yourself before buying a stock. Second one is about practicing diversification. And third is cost averaging, dollar cost averaging strategy. So that one I will go through in details later on. And for technical perspective, there are two things I need to take notes. One is the pre-trade risk management criteria. Pre-trade means before you enter into your investment transaction. The other one is a post-trade risk management criteria. So these are the two things that I will go through with you on the technical part. So later on, we'll go through one by one. We will start with fundamental first, then we follow by technical. So look at the first thing. How do you decide what to buy? On the fundamental levels, I believe many of you will have gone through this, especially when you first start investing. When you first start to invest into the stock markets, where do you get all the source of information? Definitely you will have a broker. You open a broker account, your broker will invite you into so-called, sometimes it will be a Telegram group, sometimes it will be a WhatsApp group. And within the Telegram group, within a WhatsApp group, sometimes on and off, your broker will send you some message. Your broker will send you some information. And I believe, and I really I believe that most of you will have ever experienced this, because some of your friends will tell you, hey, come on, my broker tell me that this company AYZ, they are going to have they are going to announce a very big news. So faster buy, faster buy. And you, the one that you first start your investment, you have know nothing about investment, you know nothing about all this company, because your friend tell you that his broker inform him that there's a big news coming out from this company, and you immediately going to buy into the stock. So this is one of the mistakes that everyone will make when they first starting their investment journey. Yeah. So please do not really follow rumors when it comes to buying a stock. Don't buy when people tell you that you should buy. You need to, when is a good time to buy a stock is that when you have done a proper analysis on the company that you're going to buy. If you don't understand the company, you don't even know what business that they are running, please do not buy the stock. And second scenario is that I believe this is also the thing that a lot of people will do is that they look at news. For example, they look at the Age daily newspaper. Every day they look at the Age. Today, this morning, suddenly they look at the newspaper, they look at the news, and they saw, hey, this company, suddenly news announced that they got this government construction project. The next day, immediately they go into the market, 9 o'clock in the morning, sharp. They queue at the high level and enter into the company. Yes, for sure, the first 3 to 5 minutes. If you ever notice, right, when a company made an announcement after the trading hours, because most of the time company will make announcement after 5 o'clock, means after market hour. So after company make announcement, if there's a good news, certain company got awarded certain project from the government, the next day morning, what will happen in the first 3 to 5 minutes? Share price will get up. Yesterday closed at 1 ringgit, probably the next day open 110 or maybe 105 or 110. So definitely share price will go up. Why? Because a lot of people are same like you, because they look at the news and they follow the news. Next day they go and buy. That's why there is a gap up in the stock prices. But what happens subsequently? What happened after the first 5 to 10 minutes? Most of the time, I would say 70% to 80% of the time, after the gap up, the share price will continue to go over and over. And that's where a lot of the retailer got trapped at the peak. And this is why a lot of people, they always say investment is not my game, because every time when I buy, the stock prices go down. It's not that every time, it's not that the stock markets, the stock prices always goes against you. If you ever experience that every time you buy the stock prices go down, you need to try to think about it. What is the criteria that you assess, or what are the factors that trigger you to buy into a stock? Probably you're looking at the wrong criteria, you're looking at the wrong factors. That's why you always got trapped at the peak of the stock prices. So that's why two things you need to remember over here. Do not follow news, do not follow rumors to buy into a company or to buy into a stock. So you actually need to do your own analysis in the company. And I guess probably the next question that you all will ask is that, so what are the things that I need to do? What are the criteria that I need to assess? So over here, I've listed down 5 criteria. These are not all the criteria that, these are not everything about it. It's not 100% about it. These are the 5 things that I think, these are the important things that at least you as an investor, you want to invest into a company, you should understand about all these 5 things. The first thing is what business this company is running. You need to ask yourself that this company, is it running a F&B, food and beverage business? Is it running a travel related business, or is it running a retailer business? So this is something very important. If you don't even understand what business the company is running, don't buy into the company. Because try to imagine today, investing into the stock market is similar to you starting your own business. Try to imagine if you are the business owner, you definitely have to understand the nature of the business that you are running. So that's why the first thing, something that's very important, is to understand the business that this company that you want to invest, what kind of business that they are running. This is something very important. Don't buy into a stock that you can't even understand what business that they are running. The second thing is about the management. Like I mentioned earlier on, I have a bad experience investing into a good is fundamentally strong company, but because the management is actually managed by a poor management team, that's why actually my hard-earned money actually got burned. But then management team is something that's very very important that you have to assess. Think about it. Some of you might ask, so how should I assess the management team? I don't know the people. How should I assess it? There's a few ways that you can assess the management team. One way that I always look at it is that I will look into the share prices. Is this stock that I'm going to invest, is this stock ever experience that kind of a sharp increase? For example, if you have a share price, if you have a stock price, right, it move like this, then suddenly increase, then suddenly drop, then move like this, suddenly increase, suddenly drop. Yeah, if you have ever experienced that the company that you want to invest have this kind of a stock pattern, try your best avoid from this kind of stock, because very likely that there's a lot of people manipulating the stock prices that cause this kind of a spike in the stock prices. So for me, first thing that I will avoid is that the stock prices that have a significant spike, then suddenly it actually tumbles significantly. So I will try to avoid this kind of company. The second thing that I will assess for the company management is that I will look into the quarterly reports and also the annual report of the company, because there will always be a space writing about the prospect of the company. So every quarter, every year, I will look into this prospect, because sometimes the management will tell you how confident they are that the company will be able to meet target, how confident they are that this year the company will make how much profits. So this is show you the credibility of the company. Not just that you need to look at the promises that the management have made. Over the time, you also need to check whether or not the promises that the company, the management have made, whether or not they will be able to realize these kind of promises. So this is something very important. Two things that I look at here. First thing is that the stock prices. Second thing is I look at second thing over here. I look at the annual report and also the quarterly report. Look at the prospect of the company and see whether or not the management can deliver, because the management themselves, the CEO, he is the one that understands the company inside out. He should be the one that understands how the company is performing, how the business is running, whether or not they have a strong profit, whether or not the sales will be growing at a double digit. So over the years, over the quarters, you need to assess those promises that made by the company management, whether or not they can achieve those promises. So if they over the past 10 years or 5 years, every quarters those promises that they make, they're able to achieve it, then this management team, they have a very high credibility. So these are something that I will actually assess for the company management. And the third thing is about the company performance in the past. So this is something very important. You need to know how this company perform. The company performance here is not about the stock prices, but it's more about the business itself. Whether or not the company have a strong revenue growth, whether or not the company have a strong earnings growth, and from there you also need to monitor. This company, whether they have a strong balance sheet, or are they in a net cash position, or over the years are they increasing their debt level? If they increase their debt level, what are the underlying reason? Is it the company have an expansion plan? Yeah, if the company have an expansion plan, they increase their leverage, and on as a result, you see there's an increase in sales, because when company expand, they do expansion, definitely their sales will improve. But if you look at it over the years, when company continue to increase their debt, they say that they're going to expand their business, but after 3-5 years, you still see the sales is actually declining, then there's something wrong. So these are some of the important things that we should look into it, because all these figure, the annual report, the quarterly report, it does tells you a lot of story behind. So understanding the company performance in the past is something very important. Although we know that the past performance is not indicative of the future performance, but we need to know how this company been run in the past, how this company performed in the past, to assess, to see that whether or not this company is on uptrend industry, or whether or not the business itself is actually on a downtrend. So if the business itself is on a downtrend, how are you going to say that the stock prices is going, it will actually go up? If company cannot make money, eventually the share prices will actually decline. So these are things that we need to bear in mind. And the fourth thing is about the prospect. So we know about the historical performance. We know about the past of the company. So we need to know the prospect of this company. This company, whether or not they are in for example, right now we know because of the pandemic, everyone has changed their spending behavior. E-commerce probably will be the next trend. Technology probably will be the next trend. Everyone is talking about digitalization. So if you're investing into a retail company, then probably you need to think about it. Over the next 5 years, will the company continue to make that kind of a profit that they have made in the past? So these are things that are very important, because historical is historical. Apart from looking at the historical performance, we also need to assess at the current juncture, at this moment, is there any factors that will change the prospect of the company? Now, right now we know because of this pandemic, the spending behavior, the way businesses run their business is very different from 2 years, or even 2 to 3 years ago, because before this pandemic. Now, a lot of businesses, they actually start to digitalize. So if the company that you're invested in, they fail to digitalize their business, so in certain sense, it actually tells you that the growth for this company over the next 5 to 10 years, it could be quite limited, because every business in the world, they are talking about digitalization, and the company that you're invested in, if they fail to digitalize the business to certain sense, it could actually hinder the growth of this company. So these are things that we need to think about it. And the last thing is about valuation. So if I were going to invest, how much should I pay for it? So this is about valuation. So you need to do valuation for your for the stock that you're going to invest. How much should you pay for it? So on a very common terms, people always look at PE. PE, if the earnings is $100, how much should I pay for it to invest into this business? So valuation is something very important. You also need to look at the performance of the share prices, because if the share price have varied significantly and the company valuation is went up to a very stretch level, despite that they have a strong management team, the business itself is a good business, the prospect is very good, the historical performance, they are making 20% kind of earnings growth over the past 2 years, but the valuation is way too expensive. PE ratio 100 times. If this kind of company, try to imagine how are you going to invest into this kind of company. So to a certain extent, if the valuation went a bit too stretched, there's also a time that you need to think about it. Probably I need to wait for the stock to have a pullback to correct further, then only I consider entering into the company. So these are the 5 things when it comes to fundamental analysis, when it comes to analyzing a company to decide whether or not you should invest. These are the 5 basic things that you need to ask yourself. If you can answer all these 5 questions and you think it's still a yes to buy the stock, then yes, please go ahead to buy this company. But before understanding all these 5 questions, before you can answer these 5 questions, please do not buy into any company. Because if you are doing so, it's similar to you placing a bet in a casino, either big or smaller. Could be either go up or even go down. But when it comes to investment, we don't want to have this kind of attitude. We want to know company well. We need to understand the company. So we need to do our own fundamental analysis on this company. So after knowing about the fundamental analysis, after knowing about the management, after knowing about how to analyze the company, so the next thing is about you need to do proper diversification. I think if you all still remember what I mentioned earlier, investment is actually a game of probability, and there's nothing 100% for sure. So in such a scenario, if investment is a game of probability and there's nothing 100% kind of a sure win kind of a trade. So what should we do? The very important thing is that you should diversify your portfolio. So we all know that diversification is actually for the purpose of reducing the risk of our investment. But think about it from another angle or from another perspective. Diversification is actually meant to eliminate the element of emotion from your decision process. No, before you make an investment decision or before you make a buy or sell decision, the reason why you want to diversify is that you want to eliminate the element of emotion. Because if you try to think about it, right, if today you only have a stock in your portfolio, 100% of your wealth you buy into a single stock, buy into one company, or you buy into stock that within the same sector. For example, you buy into all Gulf stock, you have Supermax, you have Top Gulf, you have Corsan, everything, all your portfolio only Gulf stock. You think about it, what happened if the stock prices drop? Or the sector outlook, the growth sector outlook being affected because there's vaccine available, or we know the ASP we're going to decline, the growth prices continue to fall. So what happened if the price drop? You will start to feel panic, you will start to feel nervous, or even to a certain extent, when top growth prices drop from 9 ringgit to 6 ringgit, you will even question yourself, you will even doubt your investment decision. You will doubt yourself, am I making a good decision? Is my decision to buy into this growth sector is a right decision? So probably you will make a decision to sell even if the company is a good company. So remember one thing, diversification is actually meant for the purpose of eliminating the element of emotion in your investment decision. Because try to imagine today, if you have two stock, stock A and stock B, they are not correlated. You diversify into different sector. So if you look at your portfolio itself, stock A dropped a bit, but stock A dropped a bit, but stock B went up. So your mood, you are not in a panic mood, you are not in a nervous mood. And in that kind of situation, you can make a sound investment decision. But if you are nervous, if you are panic, you think about it, in that kind of situation, how do you sure that you can make a sound investment decision? So that's why, remember one thing, investment is a game of probability, and playing the game of probability, you actually need to have certain level of diversification. Don't over diversify, because over diversify, it will actually dilute the returns of your investment. Don't over diversify, but to a certain extent, you need to have a proper diversification for your portfolio, because you want to eliminate the element of emotion in your investment decision process. And if you think about it, this few chart here, I believe you're probably aware of this. In the first 8 months of 2020, sorry, in the first 8 months of 2020, the healthcare sector or the growth sector, the prices actually fly sky high. But what happens on the opposite, financial sector, because of the lockdown, banks offer the moratorium, a blanket moratorium to everyone. That's why they need to have provision. Bank is also expected to have a higher level of bad debts. Also central bank cut interest rate. There is a net interest margin compression for all the financial sector. So that's why the stock prices for all the financial counters actually went down. So try to imagine, if you at that point, if you only have financial sector, what happens to you is that you will feel very panicked and very lost. But at the same time, if you have both financial and healthcare sector in your portfolio, is that you'll feel okay, because at the other side of the portfolio is actually making good profit. So if you are holding a good and sound financial counters in your portfolio that you have done through all the analysis, it's okay for you to keep on holding to it, because what happens subsequently, most of the stock prices actually rebounded after September and also October. But if you imagine, if back then you only hold financial counters, at that point when it dropped 30%, 40%, what would be your decision? Probably at that time you already sold all your investment. Yeah, so that's one of the important elements about diversification. So it actually eliminates the element of emotion from your investment decision process. And the other thing, try to imagine, in the first 8 months, you miss out growth sector, you miss out the healthcare sector, and you decided to enter exactly at August, or exactly in August or September. What happens subsequently? the sector actually on the downtrend, on a declining trend. And if imagine at the same time you also have technology counters in your portfolio, so you were able to hedge the downside in the healthcare sector. So you wouldn't be able to afraid because you know probably Top Golf is a good company, is a good counter. You have done all your research, you have done all your analysis. They pay a very high dividend, and over the next 2 to 3 years, although the average selling price is expected to decline, but to a certain extent, you think that hey, this is a good company, I should continue to hold on to it. Why not I continue to hold on to it? Because at the other side of my portfolio, technology is doing well. I'm not afraid of the losses that I make in healthcare sector. So in that sense, you are not panic, you are not nervous, and you won't make an investment mistake. You won't make a mistake to sell off your share at the lowest point of time. So try to imagine, try to remember this. Diversification is really something very important. Don't ever concentrate your investment into a single stock, or don't ever concentrate your investment into a single sector. You need to at least diversify across 2 to 3 sectors to have proper diversification for your portfolio. And the next thing, the third thing, and also the last thing for fundamental part is the dollar cost averaging. So I believe many of you will have understand what is dollar cost averaging means. Over the time, if the stock prices drop, you tend to buy the equivalent, the similar amount of money, because the stock prices is at a lower level. With the similar amount of dollar, you will be able to buy more units, and that's why you're able to reduce the weighted cost of your investment. But remember, before you do dollar cost averaging for your investment, there are a few criteria that you need to remember. You need to make sure cross-check this criteria first before you do dollar cost averaging for your investment. The first thing is you must understand the company. So you need to make sure that step number one, you did it right. No, step number one is about understanding the company. Do all your fundamental analysis, and then you practice proper diversification. So move on to the step three, which is the dollar cost averaging. The first important thing is also make sure you understand the company. Make sure that this company is a good company with a strong fundamental. And the other thing you need to make sure is that there is no significant change in the business operation, because in certain time, in certain period, right, or in certain case, right, there is this company that is fundamentally strong. They make good profit in the past, but suddenly probably this company in the past, they're actually relying on a government license, a certain government license to run the business. But government suddenly announced in the next 2 years they are going to withdraw the license from this company. So by withdrawing the license, it means that the historical performance, the profit that they made in the past, wouldn't be able to repeat in the future. So this is something that very important. And if there's something that happened to the company or to the business, then there's a point that you need to do further assessment. You need to do further analysis on this company. So you need to make sure that there is no significant change in the business operation. Then only you can do dollar cost averaging for your investment. Don't simply do dollar cost averaging for all your investment, especially the fourth thing. Do not cost average on any penny stock. I believe many of you recently, probably you all heard about a company like Vivocom, or previously there's a lot of those penny counters from a few cents all the way up to $1 or even $2. So what happened is that a lot of people got trapped at $1.80 or $2. Subsequently, when it dropped to $1, they say, never mind. I dollar cost average. I buy more at this point. Last time I bought $2. Now I bought $1. I can buy even more units. Try to think about it. If you buy into a company that don't have a strong fundamental, if you buy into a company that's purely, we call it those goring stock, those stock that purely for goring purpose, those penny stock. If you dollar cost average on this company, I think the outcome is likely you will end up dollar cost average for a few more times until you give up. Yeah. So these are things that you need to take note. If you want to dollar cost average on your investment, make sure that you know the company, make sure that the fundamental is good, and you need to make sure from the day one you start your investment until today, there is no significant change in terms of the business operation. Do not dollar cost average on the penny stock, and do not dollar cost average on those stock that you buy because of rumors, because your brokers, because your friend, he say that he know somebody inside the company and he know there's something coming out, but ultimately the stock prices drop. So bear in mind, don't do this kind of thing, because these are all your hard-earned money. We don't want to lose even single cent of our hard-earned money. So please have a proper investment plan for yourself. Please have a proper risk management strategy. And this, on the fundamental perspective, these are the three things that you need to understand. First thing, you need to understand the company inside out, do your fundamental analysis. Second thing, you have to practice certain level of diversification, because we know investment is a game of probability. There's no something so-called 100% for sure win kind of trades. So you need to practice proper diversification. And if you follow the first two steps, you understand the company inside out. So when the stock prices drop because of the broad market weakness, right? For example, back in March last year, because of the pandemic, the broad market dropped. There's a broad market weakness. Every stock, no matter good fundamental or bad fundamental stock, everyone dropped. So in that kind of a period, what you can do is that you should actually dollar cost average, because you know the company well. You know that no matter how, over the next 1 to 2 years after the pandemic, after the COVID-19, the company for sure can come back. The business won't be affected, or even certain company that will be benefited from the pandemic. So that's exactly the time where you need to dollar cost average on the investment. Dollar cost average on the good stock. Do not dollar cost average on those company without fundamentals. And if I move on to the next slide, over here, we're actually looking it from a technical perspective. So just now, what I've explained over the past 30 minutes is all about from the fundamental perspective. You need to do analysis of the company, of the business itself. So when we decided that this is a good company that I want to buy, so I need to look at from the technical perspective. At which point should I buy? At what prices should I enter into the company? So there are a few things on the risk management perspective before you enter into this trade. These are the three key things that you need to understand. The first thing is about the trend of the stock. So how to identify the trend of the stock? For stock, basically we call it, there are three trends. One is uptrend. The other one is downtrend, or the stock is actually consolidating. There's no trend. No, it's moving, or we call it sideways. Okay, so it's either the stock is on the uptrend, downtrend, or they are consolidating. So they are on a sideways. For me, I only buy a stock with the uptrend. So I don't trade those downtrend stock. The reason why is because, think about it. If you want to buy a company, if you think that the company can make money, you only want to buy a company that everyone is buying. And if everyone is buying the company, every fund manager is buying the company, what happens to the stock prices? It will continue to move on a uptrend manner. If the stock is on a downtrend manner, I believe many of you like to catch the falling knife. You like to catch something that's dropping, or especially those stocks that drop 20%, that drop 30%. But bear in mind one thing: if you catch the falling knife, there will be a time that you will gonna burn. And don't ever catch a falling knife, because you wouldn't know where is the lowest point for this stock. We always say when it comes to stock investment, right? We always say there is no lowest price. There's only a lower price. So try to bear in mind that on a downtrend stock, there's no lowest. There's only a lower and lower price. So don't catch a falling knife. Don't buy into those stock that on a downtrend. For me personally, I only trade uptrend stock. I only buy company that's on the uptrend, because uptrend stock is those that a lot of fund managers, a lot of insti players, a lot of the people that they are looking at, because people understand the value of the company there. So buy a stock that's only in the uptrend. So there's a few ways to understand the trend of the stock. If you want a fast way, probably you can refer to for me, one of a single way to identify the trend of the stock is to look at the stock prices, and you plug in one indicator called exponential moving average. We call it EMA. So if you plug in exponential moving average and you put 25 days, that one is my key benchmark. If the stock prices is above the EMA 25, we call it exponential moving average 25, then the stock is on the uptrend. But if the stock prices is below the EMA 25, technically this stock is on the downtrend. So for me, I actually follow this EMA 25 to see whether or not the stock is on the uptrend or is on the downtrend. So that's one thing very important. For me, when I buy into a stock, I only buy a stock that's on the uptrend. So that's my key, my risk management strategy, because if you touch on the downtrend stock, probably the chances of you burning is very high. And second thing is to identify, before you investing into the stock, you need to identify the support and resistance. Why I need to know the support and resistance? For example, if right now, let me give you an example. Right now, if you look at a stock, it's trading at $1. So let's say the stock, the support level is about, let's say 90 cents, right? And I tell you, the resistance is about, probably resistance is about 130. So means that if the stock price move up, there is a chance that it will hit 130 before it retraces, because the resistance is at 130. But if it drop below 90 cents, it consider it breached the support. So that is a point that I will actually cut loss. So if you look at this kind of trade, if you make a profit, you will make 30% of return. But if you enter now and until your cut loss point, you only lose about 10%, right? So if you look at in this scenario, the risk reward is actually 1 to 3. You lose 10%. You win if this trade is a successful trade, you actually make 30%. So in this kind of scenario, you have a risk reward ratio of 1 to 3. So this is considered a good stock for you to buy. So for me, I always practice this, especially when it comes to the technical analysis perspective. Whenever I buy a stock, I need to make sure that I can identify the support and resistance. At what point, when it dropped below, I will actually cut loss. At what point, if it hit that price, probably the price will retrace, and there is a point that I will take my profit. So by knowing the profit point and also the cut loss point, I will be able to know the risk reward ratio for my trade. So if you want to enter into a trade, please bear in mind that you need to trade a stock, or you want to invest a stock that have a good risk reward ratio. What do I mean by good risk reward ratio? At least risk reward ratio of 1 to 2. If you have a risk reward ratio of 1 to 1, I don't think it is meaningful for you to enter into the trade. For me, at least I buy into a stock that have a risk reward ratio of 1 to 2 or 1 to 3. Don't buy a stock that, if you lose 20%. If you win 5%. So this kind of stock is a bad risk reward ratio. So don't ever trade a stock that have a bad risk reward ratio. And you need to understand the support and resistance. Try to identify the support and resistance that you set for your stock. And for the post-trade risk management, so we know about the pre-trade risk management. On the pre-trade risk management, 3 very important things. First, identify the trend. Second thing, identify the support and resistance. And the third thing, make sure that with the support and resistance that you have identified, make sure that there is a good risk reward ratio. Then only you consider entering the trade. And for the post risk management plan, very, very simple. It's all about sticking to your plan. If the stock hit your cut loss, hit your support level, break below your support level, just stick to your investment plan and cut loss. That's something very important. But I know it's always easier said than done. When it comes to a point where you need to cut loss, you will try to, should I cut loss? If I cut, I lose 10%. Should I cut? Or should I wait? Wait for another 1 day, 2 days, or probably wait for it to drop further. See, probably it can stabilize and rebound. So, those are the emotion thing that actually kicks in. So you need to make sure that you are disciplined enough and you always stick to your investment plan. So I give you a few examples over here. Try to think about it. This slide here, sorry. The first scenario here is that you need to monitor the support, because wherever if the stock prices break below your support point. How to identify the support? You see, whenever it hit this point, it actually rebounded. It hit this point, it rebounded. It hit this point, it rebounded. But over here, it break down already. Then subsequently it rebound, but it continued to break down. At this point, when it break again, that is where you should actually cut your position. So this is another strategy for your risk management when it comes to a technical perspective. Whenever the stock prices break below your support level, that is where you should cut. We always say when it comes to investment, right? Don't fall in love with a single stock. When all the indicators tell you that there's something wrong, when all the indicators tell you that you should sell, then you should stick to the investment plan and sell the stock. No, there's 1,000 stock in the stock exchange. No, you don't. We are not fearful that we are not afraid that there's no stock available for us to trade. There's a lot of stock out there for us to buy, for us to trade. So if the stock that you invested it break the support, so just stick to investment plan and cut loss. That's something very important. I said earlier, it's easier said than done. What we need to do is that over the time we tend to practice. Every time when it hit our support level, it break our support level, we just need to stick to our plan to cut loss. The other thing, just I demonstrate to you about the breaking of the support. The other thing is also the change in terms of the trend. So just now, if you ever if you still remember what I shared with you, use EMA 25. So over here, let me see. Where's EMA? So over here, this green color line, this is EMA 25. So use EMA 25 as the indicator for you to identify whether or not there is a change in the trend. So look at it. When the stock prices is moving up, EMA 25, so it's actually on an uptrend. Over here, it's sort of consolidated. It moved below the EMA 25. But starting from this point onwards, it continued to drop and move significantly lower the EMA 25. It means that there is a change in trend for the stock. There is a change in trend for the stock. From the uptrend, it actually moved towards a downtrend. So this is now a downtrend stock. So whenever the stock that break the trend from the uptrend to a downtrend, then there is a time where you need to make the decision to sell your investment. So bear in mind two things. First thing is when the support level is broken, you need to sell. Second thing is that whenever there is a change in terms of the trend for the stock, you need to sell your stock. And by selling your stock, you are actually managing the risk that you are taking for your investment. Yeah. So yes. Okay. So I come to a conclusion for today's session. So these are the things that we have discussed just now. Why we think that risk management is important, because we need to acknowledge the fact that first thing, we can't control and we can't predict the direction of the stock prices, especially over a short period of time. Second thing, we need to acknowledge that investment is actually a game of probability. No one will ever know that what's going to happen, and because that is a game of probability, we need to have proper diversification. We need to manage our risk well, because we want to make sure that if we win, we want to win a lot more. When we lose, we want to control our losses. We want to reduce the impact. Risk management is a way for you to reduce the impact when it comes to negative scenario or negative event. And the third thing is that we need to understand a best loser will be the long-term winner. So having a prudent risk management strategy, it will help you to become the best loser in the stock markets. And how exactly we can practice a good risk management strategy for our stock investment? On the fundamental perspective, you need to know how to pick your stock. So you need to know the company management, you need to know the business itself, know the fundamentals, know how the company perform, and you also need to know the prospect of the company. Last but not least, the valuation that's going to pay, the price that you're going to pay for this company. By understanding all the fundamentals on top of it, you actually need to diversify. Why? Because investment is a game of probability. I've repeated many times this sentence. Investment is a game of probability. So diversification is something very important. And last but not least, cost averaging. If you have practiced the step 1 and step 2, pick a good stock, diversify. Then, if the company is a good company, try to do cost averaging if the market is very weak. And from a technical perspective, 3 things that you need to know: understand the trend, do not trade, do not invest into a downtrend stock, only buy into an uptrend counters. Second thing, identify the support, because the support is a point where you need to cut. If the support is broken, you need to cut your investment. Last but not least, only buy a stock with a good risk reward ratio. What do I mean by good risk reward ratio? It means at least the risk to reward is 1 to 2 and above, at least 1 to 2 or 1 to 3. So do not trade a stock that only have a probably you lose 20%, and if you win, you only win 10%. So this kind of risk reward ratio is not attractive enough. It couldn't justify for you to enter into the trade. Okay, so I think with that, I will come to the end for today's sessions. And I think we will still have time for Q&A session. So I will pass the floor back to Shane.
Thank you very much, Jerry, for sharing with us your nugget of wisdom and also your strategy when it comes to risk management. So we learned from Jerry that risk management involve either one of them, which is if you can use fundamental or use technical for you to reduce your risk in whether you're doing trading or whether you are doing investing.